Welcome back in, investors. I hope you had a wonderful Valentine and spent it with somebody special. Now, before we get into today's video, I do just want to talk through what's going to happen with the channel here. I personally had to take an opportunity for personal reasons. It's just something I have to do for me and my family personally, and it's going to take me away from creating more videos. So going forward, I'm really focused on the public account that I've been kind of sharing here. That's going to be the premise of this video. I'm still going to break down individual stocks, opportunities that I see. And at the end of March, we're going to be rebalancing the portfolio here, but I want to talk about some key positions overall and an opportunity that I think could be presenting itself. So make sure you stay till the end. We're going to break that one down together. So let's get into my portfolio. As you guys can see here, I'm basically keeping up with the benchmark. We're sitting at 3.58% gains for the first couple months of the year. Benchmark is sitting at 3.7, so slightly underperformance here. But what I want to point out is I'm going to be relying a little bit more on dividends than most portfolios. So we have to kind of let this thesis play out for the rest of the year to see if I beat the benchmark. Now, over the last couple months, we've been accumulating shares of Intel around $19, Paramount Pictures around $10 and change. We just built into a position of Wendy's. In our two core positions is Vici Property and Pfizer. Now, after Vici Property announces earnings, I may be peeling back on both Vici and Pfizer here a little bit, build some cash, deposit some cash in the portfolio because I am looking at some interesting opportunities. The biggest opportunities I'm personally seeing are companies that are trading between $1 and $15 billion market caps. The problem is with higher interest rates, this is going to obviously keep those prices depressed because they are smaller cap companies in the capital markets. They usually really are reliant on, and everything's kind of thrown out with the baby with the bathwater when we talk about those smaller cap companies because of those higher interest rates. But I think that's where you're going to find some tremendous upside. In October, activist Starboard picked up $1 billion shares of Pfizer. We obviously know that there's been some struggling here with Pfizer's future, although earnings have been pretty resilient. We're going to see a major drop off on COVID remedies, and that's obviously scaring the market. RFK getting in office is scaring the market, and this has brought Pfizer down to really depressed valuations, and the future is definitely uncertain when we look at their pipeline. Now, this was just a few short months ago, and what took place? Well, they added into more Pfizer on February 14th, and when we look at their top holdings as of December 31st, it's GoDaddy, Gen Digital. Now, if you guys remember, Gen Digital's one we broke down in the low teens. I was pounding the table on this one. It has doubled in less than a year. Match Group is another large holding, Kenvue, and then we see Pfizer here, which they did add another $350 million worth of shares, bringing up the stake to $1.35 billion worth of Pfizer. So obviously, they are pretty confident here that there is going to be some value unlocked in Pfizer. I think we're starting to reach peak pessimism in Pfizer, and once again, pretty similar to Intel. I think there could be something that really turns this around when we look at, 8 times earnings. This is a company that's projecting out to earn nearly $3 a share next year, and just bumped up their dividend, now paying at a 6.74% dividend yield. Personally, I think the majority of your gains over the next few years are going to come in the form of a dividend until they really can build out this pipeline, make investors confident once again. And this could be a long-term turnaround play here, but I do think there is some promising things actually coming through their pipeline, along with a little bit of Vici Properties here. Multiple reasons why I think they can do well. The casinos are reporting extremely strong numbers, first and foremost. We see what's taking place in California, and we see a lot of companies now starting to go to places like Texas and Nevada to start their businesses, very friendly areas. I think this bodes well for something like Vici Properties. And so we're seeing a great growth rate with the company. We're seeing a great valuation. And over the last 6 years that they've paid this dividend, they've raised this dividend. So we've seen very great fiscal responsibility as well. So I think there's growth opportunities for the company still. I think the valuation is very reasonable when we compare them to their peers. So I really do like this one, and I probably let some shares go if it starts approaching the higher 30s. But Vici and Pfizer are two core positions that pay high dividends, and I'm relying on those dividends for total returns, which is going to leave you scratching your head to why the hell I picked up something like Wendy's. Now, for me, I'm definitely a contrarian investor. I look for opportunities that nobody else is really looking at that I think has upsized returns. I want to beat the market. If I just wanted to keep up with the market, I would buy an index and maybe layer it with the triple Qs to make sure I get overexposure to technology. That's not the path I'm wanting to take here for this public account. The path I'm wanting to take is a little bit more higher risk, a little bit more reward, and finding prices that should be closer to a bottom at this point in time. And I think Wendy's fits this in multiple ways, and let me explain the reasons why. If you guys caught my last video, I did point out Wendy's was going to cut the dividend, and once they cut that dividend, I am buying in this stock. And take a look at what happened. They cut the dividend down from 25 cents, which was nearly a 7% dividend, to now 14 cents, which gives it over a little bit of a 4% rate of return for me, because I did buy the dip around $13.80, and I'm actually holding on to some more capital to buy around $10 if it gets to those levels. I really like what the CEO is doing here. The CEO wants to slash its dividend to start focusing on growth once again, expanding internationally, and when we look at the valuation and margins, it's very enticing. So when I read through the quarterly report, they're guiding for about $1 to about $1.02 of earnings next year, which means that when I bought it at $13.80, for simple math, I was buying at a 13.8 PE ratio, which puts it well below its peers in almost every metric. Now, buying at those levels was giving me over a 4% dividend yield, which is double their sector median. So I'm buying it at a 50% discount to its sector median. I'm getting double the yield from a sector median. I think there's actual growth opportunities with this company. And if we look at the history, even though it hasn't been pretty, this is a company that does try to return capital multiple ways. For 21 years, they have paid out a dividend. Now, the other thing that they're doing is buying back a tremendous amount of stock. Now, Wendy's is outlining 2 to 3% for 2025 net unit growth aimed at tech investments and global expansion. They're doing that with buying back stock, with paying a dividend, half the valuation to its peers. And so I do think this is a long-term buying opportunity for a company like Wendy's, and I would like to get in a little bit cheaper here, because when we ran our analysis, we were basing our returns on what the dividend was going to be. So for most stocks, I like a 10% rate of return, but when we factor in total returns, so this company was paying out a 7% dividend, which means that I only need about a 4 or 5% rate of return. We get roughly a $15 stock price, but because they cut that dividend and they're going to grow around 2 to 4%, as you can see at the top here, I have them growing 3% pretty consistently. I think they can beat this, but we're just going to say they grow 3%. Now I'm getting a little over a 4% yield, so now I can just bump my required rate of return up to 7. And you guys can see here around $11.50 is an ideal stock price. Now from a free cash flow standpoint, we can be looking closer to $20 a share, but between 11 to about 14 bucks, I thought this was interesting, so I started nibbling around $13.80. Now, as I stated, if it breaks down to $10 a share, this is where I would possibly be doubling my position, as long as the fundamentals are still intact. And so this is why I've accumulated Wendy's. For quick service burger restaurants, as I stated, McDonald's is number one, obviously the king. But we take a look at Wendy's, and getting at around 13 to 14 times earnings, paying over a 4% dividend yield, getting around 2 to 4% growth, and being the second among the largest burger chains here, I thought this was a pretty unique opportunity. I hate restaurants, but once again, they basically have double the net income margins to their competitors, which is going to lead us to Intel up 23.5% in the last 5 trading days on some interesting news here. Now, I took some off the table here. I thought it was a smart move just to kind of limit my exposure, take these massive outsized gains. People don't even make 23% in 1 year, let alone on a position that really didn't have any groundbreaking news that moved up 23%. Now, what I'm personally waiting for is the turnaround to really start here. I'm waiting for a CEO to be announced. I'm hoping it is a banger of a CEO. I'm also waiting for possible merger news and or spin-off news, and the fact that they could have some demand coming in the near future. Granted, they're losing market share, but I think this is priced into the stock. So we took some off the table on Intel. We had over 350 shares. Now we got it down to about 265 shares. We're most likely going to hold this. As I stated, I think the news can be more positive than negative at this point in time for Intel, and I think that's why we've seen it move over 20% in less than 5 trading days. And with a lot of tariff talks on the table, we're seeing companies like TMC considering running Intel's US factories. Trump is really pushing for domestic chip manufacturing here in the States, which will create jobs and also be a state of security here for the US. So multiple ways I think Intel can win. It's a very unclear picture, obviously, but I also think that has been priced in the stock, very similar to Pfizer being priced where it's at as well. All these companies have actually been really hated, and that's why I do think they could be outperformers going forward, because they're all under-owned. Any sort of positive catalyst or positive news can send these shares skyrocketing, because there's a lack of ownership in most of these names. Which is now going to lead us to DXC Technology Company, ticker symbol DXC. This one is a wild card, and I do think we're getting close to a bottom. This one's starting to pique my interest. Once again, contrarian turnaround story, just like everything else in my portfolio. So we got a $3.6 billion market cap of this company. Now, this is a company that has declining revenue from $17 billion down to $13 billion in total revenue. And this is why we've watched the stock absolutely tumble. But this is a company that can generate some pretty good cash flow here. We're looking at over $800 million of free cash flow. Now, what they're guiding for is the most important thing. This is a very volatile name. I've seen it trade as low as $14 recently and as high as $27. We can see here it closed around $20.20. I think this is something I would probably maybe get a little more interested on in the mid-teens. But the odd thing is when I take it over to their ratings and report, Schwab does have this as a B rating with a likelihood of outperforming the market. And most companies actually have it as a hold, and it recently had upgrades on its last earnings. This is an IT services company that really focuses on automation for operations, making businesses run more efficient with automation. Their largest partner is Dell, and Dell is definitely going to be a player in AI, no questions asked, which makes me think that DXC is kind of a quiet AI play here. When we look at a $3 billion market cap and how some of these companies are trading for wild valuations, this one is becoming interesting to me at this level. Now, of course, it has its problems, but I also think it has its footprint. They have 2,000 plus customers in 150 countries, and they have employees across the globe. We could see some of their partners as well. So they do have a decent footprint here, and they are coming out with new technology. Now, with these declining revenues, obviously it's a little scary, but the fundamentals are really not that bad in this company when we look at a $3 billion market cap. They reported on February 4th, 2025. Now we can see here that revenue was down 4.2% year over year, but they grew their EBIT margins and they did grow their adjusted EPS. Now, when you go down the line items, you're going to see down 4%, 1%, 10%, but overall, they're down 4 to 5% on revenue. But global infrastructure services book-to-bill ratio of 1.44 compared to 0.73 is telling me that there are getting more bookings now, which could start leading to growth. So now my goal is to reconstruct this company to where I think they can actually perform. I think going forward, negative 3% growth for the next 3 years could make a lot of sense. We're starting to see negative 4 and 5% for the quarter. So I think over the next couple of years, maybe we get an average around negative 3% revenue growth. From there, I'll say they grow 1%, and from there on in, I'll say they grow 3%, where I don't think they're going to be losing as much market share and as much revenue. Now, this is highly speculative, but I want to get a jumping off point before their next earnings so I can replug in these numbers to see exactly where the company is heading. Now, to be completely transparent, I don't know where these numbers are going to come out to. I am just doing this live with you guys. It's actually going to be a learning experience for me as well. Now, with all this bad news, this company is carrying $1.2 billion of cash and cash equivalents. As we can see, it is coming down here, but it does still have a pretty healthy cash position and about $4.8 billion in debt. And that's coming down as well. So they are paying down their debt. And the other thing is, take a look at how many shares they're buying here. They went from 257 million shares outstanding down to 183 million shares outstanding. So you can kind of see the story I'm telling myself here. I'm saying that they're not going to buy back any more stock. They're still going to pay down their debt. Maybe cash grows a little bit here. And they're going to still have a few years of negative revenue, but stabilize and go into possible positive revenue growth. Now, the hardest part of this is going to be figuring out what kind of multiple we want to put on this stock because revenues are declining. It's basically getting priced in for some bad things here. And I think the fundamentals are still strong enough and the footprint's still strong enough to where they could stabilize and possibly grow unexpectedly. So we see here that they're trading around 3 to 4 times enterprise value to EBITDA. An industry standard trade around 15 to 20 times. So if I'm building myself a 10% required rate of return here, and I put an 8 multiple on this company, we ideally want to be buying the stock for around $17 a share, which is that ideal range that I was talking about, mid-teens. So just by a quick glance, that's about where I thought it would make sense. For DXC Technology, as we could see, I mean, even if we take it from a technical standpoint, if we drew a line straight down here, yes, it's in a downtrend, but it could be actually breaking out of this downtrend as well. So even from a technical analysis analysis, maybe it's starting to find a bottom here. We could even be looking at a left shoulder, a head, and a right shoulder forming here. So this one's an interesting one to keep an eye on. Ideally, I do think I would like to get it closer to that $17, $18 mark, maybe average in a little bit, hold on to a very small position into next earnings, and then really dig into next earnings to see if this company is stabilizing. Once again, this is a very higher risk, higher reward type of name, but I also think the valuation is pretty compelling at these levels. As always, guys, that was my dive into DXC, and we will see you all in the next one.